Good morning. I'm Bob Golden from Technomic, and I'm going to be presenting this morning's Technomic talk, taking a look at the food industry 2015, where we have been this past quarter, the second quarter of 2015 and year to date. Like to acknowledge the support of IFTA, who is partnering with us, and a few details on this program. We are recording, and we will have the audio and a print version of the presentation available for anyone who's interested on our website, www.technomic.com, later this afternoon. We have record registration for this, so we're very excited. We aren't going to be taking any questions live, but if anybody does have questions, we'll be glad to respond to them. Simply ask the questions in the chat box on the bottom of your GoToWebinar window, and we'll get back to you in the next 24 hours. My contact information is here. I welcome any and all feedback on the content presented or any other industry issue. So with that, we'll get started. Again, our focus is to look at the entire food industry, not just food service. I think it's instructive to look at the interplay between the two major channels, at home and away from home, and see how both are working. Some headlines. Really very, very positive news for the most part. One is that we are, and we'll elaborate on these, the economy is solid by almost every measure. Consumer mood is positive, again, both in terms of current and future expectations. Food service is strong, stronger than we even anticipated our last update. And we are seeing very definite signs of a chain market rebound, which we'll talk about. At the same point in time, traditional retail, by that we mean supermarket and supercenter, is soft. So food service is winning the battle at this point. We are seeing a tremendous amount of pressure being put on, quote, big food, big brands. To their credit, are responding quickly, responding aggressively, but we are seeing some pretty significant changes in the market overall with respect to emerging brands, acquisition activity we'll talk to, and we will spend some time on some of these new growth sectors that are emerging and experience accelerated growth, things like online. So with respect to the macroeconomic indicators, the percent versus, when we're looking versus a year ago, disposable personal income, we're showing 3.5% that growth. That's very, very good news, especially for food service, which is such a discretionary and income-dependent industry. Gross domestic product, GDP, up 2.3%. There have been some upward revisions. They're likely to be, so economists are still forecasting somewhere around a 3% growth for this year, which, again, I tend to take the good news. That is quite good. Employment is up 2%, 2.1%. Unemployment is down to 5.3%. Underemployment is down. Consumer spending is up almost 3%. Housing prices and housing starts are both up, and there's actually a short supply of stock in a growing number of markets. Rental rates have actually escalated to a point where more buyers are returning to home purchases, which will help that sector. The other side, which is another major industry, drives a lot of employment. Auto sales are on track to be 17 million units. That would be the best performance since 2001. And interestingly, what's growing? SUVs and trucks, largely based on the drop in fuel prices. And what we've seen in fuel prices, we're averaging about $2.65 a gallon, and that is down $1 a gallon versus last year, which certainly is helping spending to a certain extent. On the inflation side, we have overall, with the exception of away from home food, which I'll talk about in a moment, very, very moderate. The Fed keeps threatening to raise interest rates. They signal they will, but our view is it's going to be very, very modest. Overall, we're basically looking at less than about 0.1% inflation. That's all goods and services. Producer price index down 1. There was a few categories where, most notably eggs, where there's some significant exceptions, but by and large, PPI is down. At-home food we're experiencing only 1%. And away from home, which is, again, a bit of a challenge, I think operators are certainly more confident in their ability to take price in this more positive environment. They're also taking price increases, largely, in our view, with respect to labor, which is a major challenge in terms of cost increases and expected cost increases, which we'll come back to. So again, here, generally very positive picture. If you look at some of the sentiment, because a lot of the industry is driven by mood and feel and expectations. This is the university consumer sentiment. You could see the gradual upward rise, the recovery from the recession in 08 and 09. We're back almost at 100, which would be the 1966 index. Consumer expectations are very bullish, and I think this is probably the best news of the day in terms of consumers took a big jump. We're sensing that the economy's doing better, employment's better, housing's better. All these macroeconomics are positively influence the mood of consumers, so we're actually at 109. And a similar index, consumer confidence, very well publicized from the Conference Board, we are now over 100. So again, very much good news. One of the major dynamics that we're seeing a real rebound is the chain market, which has really struggled for the last several years. Chains did okay during the recession. Independents suffered, that the pendulum swung. Independents really took the lead. But right now we're seeing a much dramatically improved chain market. If you look at limited service, 91% of the chains, these are public chains that report quarterly, 91% of them are reporting growth with an average same-store sales increase of 6%, unweighted. Full service, 82% report growth with an average growth of same-store sales growth of 3%. In total, 86% of chains are growing. Same-store sales increase is 4%. And all indications are that independents are doing equally well, if not better. There is definite unit openings, investor dollars. We're in the process of doing a very major study on the independents where we'll have harder data, but all our survey data is that side of the market is doing pretty well. If you look at some examples, we're seeing some pretty tremendous growth in terms of same-store sales in many cases by players that we wouldn't expect. We are well aware of McDonald's weakness, which is global, which is persisting. They certainly haven't found a way out of the doldrums. They're down 2.5%. Subway, the leader in the sandwich segment, is also down, but pretty much everybody else is reporting some really good numbers. Domino's up 13, Starbucks up 8, Burger King up 7, Arby's, not on the list, up 8%. There, We Have the Meats campaign is working very well. Chipotle up 4. They had been up double-digit prior quarters. KFC, which again had been lagging, Pizza lagging, are also reporting very good same-store sales. On the full-service side, again, the list includes some people we didn't necessarily expect to see. Denny's doing 7%. They just announced this morning they raised some guidance for the balance of the year. They're expecting at least 7%. IHOP up 6%. So these are the family-style dining segment, which has generally been a pretty slow. Cracker Barrel reports 8% in that segment. And then, coming out from some really tough comps is Olive Garden at 3%, Buffalo Wild Wings consistent at 4%, Chili's, Applebee's. You get the story. The news is very, very positive. These are really solid numbers. There has been a slowdown in unit expansion, except in the fast casual arena, and it's tended to benefit unit expansion. I alluded earlier to the fact that the operator community is challenged, and as is retail in general, with wage pressure, and it's building. We have a strong economy. There are actual labor shortages in terms of supply of quality people in many major metros, including my hometown, Chicago, New York. We're seeing wage pressure. New York City is raising, and Los Angeles, two huge markets, the minimum wage to $15 an hour. The New York increase will be by the end of 2019. It'll cover about 180,000 workers from fast food chains alone. That's with chains with over 30 units in the United States. LA, they're taking it from $9 to $15 in 5 years. Walmart, as we know, is hiking pay across the board. It's going to affect about 500,000 workers. There is an overtime move afoot to President Obama is pushing for overtime pay for workers who make less than $50,400 per year, with the effects going into with the change going into effect in 2016, affecting about 5 million workers. And both houses of Congress, as we probably are aware of, passed minimum wage increase to $12 over a 5-year time period, and they also are planning to phase out the tip minimum wage, replacing that with the minimum wage pegged to an inflation adjustment. Now, the operator community is by and large highly concerned, generally opposition. We tend to view, or at least I tend to think, that this is the move is being phased in over time, giving a lot of operators a lot of time. These are 3 to 5 year phase-ins, give a lot of people a lot of time to adjust. I also think it tends to benefit the industry insofar as it's putting some more disposable personal income into circulation. So we shall see how this nets out, but the pressure is considerable and will continue. It will be a headwind for many operators as well as others in the channel. Large broadliners are all showing some good growth. We'll talk about Cisco and U.S. Foods and PFG in a moment. Cisco latest quarters up 4%. They're reporting inflation way down. U.S. Foods, which has had some challenges, still reporting 2%, almost 2% sales growth. PFG, which is filed to go public, they're reporting 12% growth in the quarter. So again, not necessarily as strong as some of the operators are reporting. There is a definite strength among second tier and specialty distributors, as we've talked about in some of our other meetings. We're seeing generally solid performance from these companies who are reporting publicly. The first half of the year and the second quarter in particular has had a tremendous amount of very interesting deal making. The Kraft Heinz mega merger was consummated last month. The new company, which is known as Kraft Heinz, is promising $1.5 billion in cost savings by 2017. Many expect that to be even accelerated and the amount to be greater. They're also expected to deleverage very quickly as they improve profitability and cash flow. As you are probably aware, that company is majority owned by 3G with Warren Buffett's Berkshire Hathaway backing. And 3G has had tremendous results in improving margins, not necessarily top line, at Anheuser-Busch and Burger King, two other major companies they own. Ahold, which operates Stop and Shop and Giant, and Delhaize, which operates Food Lion and Hannaford, are merging in a $28 billion deal, strictly driven by cost savings. Both companies have had significant pressures by some of the other emerging retail channels and competitors. They do have extensive operations in Europe, but they do have about 2,000 stores in the U.S., high concentration on the East Coast. And finally, the Dollar Tree and Family Dollar, they've created a behemoth, about 13,000 stores, $19 billion in sales. There's about 300-400 units are going to be divested. They are now number one. Dollar General has 12,000 stores. And what's significant is the dollar channel represents a growth channel for food. It's been growing at 5 to 6%. What has deal off? I think we're all extremely well aware of the deal. I don't want to spend a whole lot of time on it. It has major implications. The fact that it's off had the deal been consummated would have had major implications. We've published an article with our thoughts. The article is called Aftermath, and it is available on our website. Gives our perspectives on what it all means to the industry, the fact that the deal has not been consummated. There's hardly a day go by when we do not hear an announcement from a major food company about responding to these very rapidly intensifying consumer demands for fresh, natural, sustainable foods. Major companies like Nestle, Taco Bell and Pizza, Panera, Oban Pan, and many, many others have responded by removing artificial flavors, removing trans fats. Panera has a publicized list of 150 ingredients which they say are no-nos, including high fructose corn syrup. A lot of move toward antibiotic-free poultry. Pepsi, for example, is replacing aspartame. Kraft and a number of other poultry. Kraft has been active in this arena. A number of poultry companies and restaurant chains are discontinuing use of poultry with antibiotics that have human health implications. So continued, and this is a very much of a partial list, we expect to continue to see a lot more activity on that front. What we're also seeing in an accelerated rate is major food companies buying at a high cost, I will say, huge premium, into niche fresh and natural companies. Hormel this quarter announced that they're going to spend $775 million to buy Applegate's Farms. Applegate is a producer of natural and organic processed meats. Applegate's around $250 million. Hormel's about $9 billion, and Hormel's going to let Applegate operate as a separate subsidiary, which is how many of these major companies are operating these niche acquisitions. White Wave, which has been a fast growth plant-based, well-positioned company. They have plant-based products like Silk and Horizon Organic. They're spending about roughly $550 million to buy Vega. Vega's a $100 million producer of protein powdered shakes. Campbell, of course, has made some very significant acquisitions of better-for-you food companies, most notable of which was their billion-plus dollar purchase of Bolthouse Farms. And they're increasing their presence in what they're calling packaged fresh foods and natural foods with the acquisition of Garden Fresh, which is a manufacturer of fresh salsas and hummus, and ConAgra, which has just announced a major divestiture of its private label business, which it bought a few years ago, bought Blake's, which is a manufacturer of frozen natural and organic meals and casseroles. The other thing we're seeing is huge. It's I guess we can call this slide "Follow the Money." We're seeing over $1 billion of investor dollars going to innovative startups. Multiple rounds, a lot of the money going to grocery delivery companies, but just give you some sense of the magnitude of some of these investments. Nature Box has raised $30 million. These are packaged snacks, plated, and Blue Apron. These are both in the meal delivery, meal kit, home meal delivery. Plated raised $56 million in multiple rounds. These are all companies that generally have multiple rounds. Blue Apron's raised close to $200 million. Instacart, which is a home delivery service, which is now valued at about $2 billion, has raised $227 million. Postmates, $138 million, another delivery service. A lot of action at grocery delivery. But restaurant chains like Cava, Sweetgreen are also Dig In, again, a meal takeout, much like Snap, are also raising in excess of $20 million. So a lot of action. There's a lot of serious investor interest in innovative niches in both the delivery, home meal kit, as well as restaurant startups. The other thing we're seeing is, I mentioned earlier that retail, and I qualified that by talking about traditional retail being largely the supermarket supercenter business being flat, and Walmart in particular, their same-store sales remains flat as they have been for many years. While at the same time, Kroger and Publix are both experiencing 5 to 6% same-store sales growth. And Kroger in particular is expanding its online presence, it's expanding its upscale presence with Harris Teeter, and it's reporting over $1 billion in food sales. And to their great credit, they've had over 46 straight quarters of same-store sales increases. But what we're seeing here is these innovative niche companies, these what we're called non-traditional Whole Foods, Sprout, Fresh Market, Natural Grocers by Vitamin Cottage, are all in the fresh format, upscale, natural segment, all reporting very solid sales growth, extensive unit growth. Fresh Market stumbled a little bit lately. Whole Foods reported a slightly disappointing quarter, but nonetheless, we're still seeing very positive momentum. In Costco, major food purveyor, up 4% ex gas. Smart and Final, another cash and carry purveyor that went public about 4, 5, 6 months ago, is still reporting 4%. They've had years of same-store sales. So we are seeing some winning formats. And the one every food company needs to take a very serious look at is what Amazon.com is doing. We have talked several times, and we have a lot of work on the online opportunity and challenge in food service as a distribution source. But Amazon is everywhere. They're launching new services almost on a daily basis. They're expanding existing service. Portal, for example, is going after the Etsy market, which is arts and crafts. Launchpad today was announced earlier last week. And it's really a very innovative, and it'll have some implication on food startups. So it makes it very easy for startups to launch, market, and distribute their products to Amazon customers, and it really offers a streamlined onboarding experience, custom product page, and access to Amazon's global fulfillment. Home service, these are going after the Angie's List business. Amazon Business, which is going to be the, hopefully, in Amazon, hopes that this will be their category killer in the wholesale market, including food service distribution, has been relaunched. Very important component. And then they are experimenting with brick and mortar stores, click and pick, order ahead, pick up. They're also expanding Amazon Fresh, a major threat to traditional grocery. The Prime Now program, lockers, which are a place to store food, their pantry program, Prime Day, which now in Chicago, for example, has just launched 2-hour delivery service. So the company's on a roll, sales are up, stock price is up, and they are just extremely formidable and shaking up the market. We've also seen a hot IPO market. I think this year got started with Shake Shack's very highly publicized and massively impressive IPO. They raised their pricing twice before they opened, and they still opened 120% higher. But big companies and small have had successful debuts. Bojangles and Wingstop. Bojangles about 600 units, Wingstop about 750. Were up 25 and 60% respectively on their first day. Smaller companies were also successful, with Fogo de Chao up 30%. David's Tea, which has about 135 units, the vast majority in Canada, was up 40%. So we are seeing a lot of interest in the IPOs. So where are we, and what are we looking for the balance of where have we been the first half of the year? We're seeing both limited service and food service tracking at the 6 to 7% nominal growth rate with the 3% inflation. You can do the math. It's a 3 to 4% growth. The all other segments, again, we're seeing a lot of strength across the board, not just in restaurants, not just in chain restaurants or independents. Both independents, chain doing well, and then you're looking at in the quote all other segments, supermarket, prepared food, lodging are both tracking in the 8 to 9% growth. Senior living in the 7-8%. So very strong B&I has come back. So we're expecting about a 6 to 7. It's pretty likely that we're going to do an upward revision in retail. 2 to 3% on the traditional, the non-traditional, which is I alluded to, many are very well aligned with the changing consumer preferences and changing consumer habits. We're seeing very strong performance in online, fresh format, and limited assortment segments. Aldi, in particular, is expanding dramatically. Lidl will be coming to this market in the next few years, and club stores and dollar stores remain solid performers. So we think food service will end up the year well in excess of retail. This is a resumption of traditional patterns. We are very likely going to be revising our food service numbers upward from where we were recently. And again, it's very, very positive news. So I want to kind of wrap up with that. I do want to point out we will be doing a third quarter update on Tuesday, December 1st, 2015. That will be our next talk, if there will be a co-sponsor of that as well. As I said, please send us questions, comments, and we really appreciate your time and ongoing support of our organization. Thank you very much.